This video is to explain the third-party financing addendum. I'm going to go over the whole thing, explain it in detail, tell you what to put in the blanks. I'll explain it a little bit from the buyer's perspective, the seller's perspective, and I'm going to give you a bunch of answers that'll probably answer a bunch of questions that you have. So real quick, let's just kind of cover the function of this form and when to use it. So you would use this form anytime you're helping a buyer purchase a property and they're going to use financing. And it's basically, for the most part, any kind of financing that's not owner financing or seller financing. So anytime they're going to a bank or getting a lender to loan money, you want to use the third-party financing addendum. And the function of this addendum in general is that it ties the approval process to the contract. So if the property or the buyer can't approve for financing, then the client has some protection there and they have the ability to get out of the contract and get their earnest money back. So let me just kind of cover the whole thing in general and then I'll dive in deeper. So it's got several different paragraphs here. Paragraph A is talking about the duties of the buyer, and then it gets into the different types of financing that the buyer can use. And so you're only going to use one of these sections here, most likely. I don't know any situation where you'd use two different kinds of loans, but who knows. All right, so then section B goes into explaining the timeline and just what's approved or what you have to, what has to qualify in order for this protection to be in place. And so one thing that's really important here to notice is that there are two different kinds of approval. You've got buyer approval and you got property approval. Those are two separate things. I'm going to go into detail about both and explain why they're both in here. And then you've got the final sections here. This section D is just for government financing, and then you've got authorization to release information. So let's go right up back to the top and go one line at a time. You're going to put the address in here. All you have to put is the street address and the city, and that's it. Paragraph A is kind of interesting, and most people think of this document as something that just gives protection to the buyer, which it does, but the buyer also has some obligations that they have to meet in order for this protection to exist. So it's saying that the buyer shall apply promptly for financing described below and make every reasonable effort to obtain approval. Okay, so the buyer can't just throw this form on there and then do nothing, expect for them to be able to get out of the contract just on a whim because they want to. That's what paragraph 23 is for. Moving on here, let's dive into this. This is saying, this is where you can describe the type of financing your client will get. And the reason why you do this is because if your client qualifies for some incredible financing up front, but then something wacky happens where you realize that loan officer was actually going mental whenever they gave your client that approval and none of the stuff that they said was actually true, then your client's going to be protected here. Or let's say a meteor strikes the Central Federal Reserve and all heck breaks loose and the economy falls apart and interest rates go sky high. I've seen that happen before, by the way. Then you're going to be protected here. And so all it's saying is that if you're using conventional financing, you would check this box, and then you've got two options here. If you're using conventional financing, you're for sure going to check this one. And most of the time that's all you're going to check. But if you're getting two loans, then you would check this as well. So an example where that might happen is back in the day, I remember a lot of 100% financing approaches would use an 80-20 scenario where they would have an 80% loan and then they'd also have a 20% loan. So you put those two loans together, they've effectively got 100% financing. Or I would hear about maybe one kind of loan that's an 80% loan and then you've got maybe a 15% loan, and then so the 80 plus 15 is 95, so then you have 5% left over. So that would mean that 95% of the financing is covered and your client only has to bring a 5% down payment. So it's just a creative approach to try and minimize your client's out-of-pocket costs with possibly avoiding some PMI or whatever. Anyway, I'm not trying to get into all that. I'm just showing you an example of when you might have two separate loans. But just for this scenario, let's just check the first box. In this line here, you're going to put the loan amount that the client has been approved for or is hoping to get. And so The important thing here is to make sure that this matches the same exact number that you're going to find on the main contract, the 1 to 4 family residential resale contract. In paragraph 3, it describes how that purchase price is broken down, how much of that purchase price is financed, how much of it is the down payment. So in line B of paragraph 3 on that 1 to 4 family contract, that's where it states the loan amount. That line has to match this line right here in order for all these protections to do what they are intended to do. Okay, and if you ever need to amend the purchase price, keep in mind that loan amount might change. And if the loan amount changes, you need to come in here and amend this as well, okay? So let's move through it. You'll put the loan amount here. It's going to be $900 million. I'm just kidding. All right, $900,000 or whatever. And it's due in full in blank years. You would put in this blank, you would put, most of the time, most people are dealing with 30-year loans, but there's all sorts of terms of loans out there. You've got 15-year and 20-year and, who knows, 10-year. So whatever number of years the mortgage is, the loan amount is for, that's what you're going to put in this blank. And then it says with interest not to exceed blank percent per annum. That means it's just the interest rate that the client's being given. The reason why it sounds kind of funny here is because if for some reason that interest rate wasn't fixed for the entire, in this case, for the entire 30 years, then let's say it's only fixed, it's only a fixed interest rate for 5 years, then you would put whatever that interest rate is fixed for, whatever the interest rate is. Let's say for this example, it's 4%, is fixed for the first 5 years. So then you put 5 years in this blank. Then after that 5th year, if it adjusts, then that's fine. It's just saying that they've got to qualify for a mortgage that's at least no higher than 4% per annum. Annum just means year, per year for the first 5 years. Now, most of the time, you're going to be dealing with a fixed rate mortgage, and if it's a fixed rate mortgage, then that interest rate that you're putting in this blank, it's going to be steady for the entire 30 years. Just a note on this. Well, I'll cover this real quick. Okay, so that covers the interest rate, and this is going to cover the loan fees. Okay, so the origination charges, as you'll see on the buyer's loan estimate. So what I would like to do in most situations is actually look at that loan estimate and look at whatever those origination charges are and make sure that whatever number I put in this blank is at least that or more. Okay, so let's just say 2%. Okay, one word I want to give you on this blank and this blank is you don't have to put the actual interest rate they're being qualified for. You just want to give it a ceiling. You want to make sure that if the interest rate goes above a certain amount, then they have the ability to get out of the contract. They have some protection there. Same thing for the origination charges. Something funky could happen later on where the client decides they want to try and lower their whatever out-of-pocket cost, and they might choose to work with the loan officer if they have some flexibility to maybe raise the interest rate so that they can come with no origination charges. I don't know. I'm just throwing out a scenario. Then you just want to make sure you might have a little bit of wiggle room there. So if my client's qualified for a 4% interest rate, I might put 4.125 in this blank just to give a little wiggle room in case it goes up, so I don't have to come back and amend this. One way or the other, you understand what the paragraph is for now. So let's move on. Every one of these sections does the same thing. It has the same type of function. So I'm not going to cover them all because you're going to be able to fill them out now that you understand what to do that I explained there for the conventional loan. The only thing I am going to explain is this blank right here. If your client is getting FHA financing, this blank is confusing. It says a section blank FHA insured loan of not less than, and then it goes on. What it's talking about here is the type of FHA loan it is. This was news to me. When I first got in the business, I didn't know that there were different types of FHA loans. As it turns out, there are. And when people just talk about an FHA loan, they're usually talking about a 203B FHA loan. There are other types. There's one that's called 203K, and it's if your client wants to finance some repair costs. It's a little bit more involved, but there's 203K streamlined, and who knows, there's all sorts of different types of FHA loans out there, but the most common is going to be 203B. Just ask the loan officer if you have any question, and they'll help clarify that. Moving on, apparently you can buy a house with a reverse mortgage. Let's move to B. Approval of financing. This is where the magic happens. So you're going to, again, put the address of the property that your client is buying there, and then here you're going to put that the contract is subject to the buyer qualifying for financing, or it is not subject to the client qualifying for financing. You don't want to just check one of those boxes. You might be asking yourself, why the heck would I use this addendum if my client doesn't care about the contract being subject to their ability to qualify for financing? Well, I think it's a great idea to still use this addendum because you have this section right here. And I'll go into that in just a second. But this gives you protection if the property isn't approved for financing. So let's just talk about this blank. I know I'm kind of skipping all over the place, but you've got this contract is subject to buyer obtaining buyer approval. If buyer cannot obtain approval, then they just have to give notice within a certain amount of days. 21 days is the magic number that you'll see in most contracts. You'll see numbers bigger than this and smaller than this. Just realize what you're doing here is you're basically setting a deadline for that lender to get their stuff done so that they can issue an approval for your client. And if you put much less than 21 days here, you could be handcuffing your lender to an impossible task. That it takes a certain amount of time for them to get that approval done. So you just want to make sure you give your lender enough time. If you're on the seller side, the lower days you see here, the better off your client is. On the buyer side, the higher number of days you see here, the better off your client is, the more protection they have. If I'm on the seller side and I see 30 days in this blank, I'm going to want to pick up the phone and call that other agent and say, what's up with that? Why do you need 30 days? Is your client like having a hard time getting qualified? What does that mean? And just try and get some explanation. Sometimes there's a legit explanation that makes perfect sense and everybody's okay with it. If I'm on the buyer side, I may try and get away with 30 days, but typically everybody just wants the transaction to go through. And so I'm going to typically put something in that blank that's attainable for my lender and something that's not going to raise an objection from the seller side. So I will typically just put 21 days. It works. Moving on here, the buyers just got to cough up all their financial information, and as long as they're doing what they got to do, and that lender, if the lender denies them and they deny them within 21 days, then the buyer just has to give written notice to the seller, and then the buyer will be able to get their the contract will terminate. Here it goes. The contract will terminate and earnest money will be refunded to the buyer. That's where it says it. Okay. Or we've already talked about that one. Now here's this one. This is pretty cool. And it's kind of surprising the first time you learn about it. The property has to qualify for financing. So this is saying the property has to appraise for a certain amount. It has to be insurable. And it has to, all the lender required repairs have to be done, or there has to be, the lender has to accept the property in the condition that it's in. If those things aren't true, then your client has protection to get out of the contract. Okay? Buyer may terminate this contract by giving notice to the seller before closing. This is the key right here. This is the surprising part I mentioned. The deadline for this is closing, all right? A lot of people will think once they pass that 21-day deadline, if that appraisal comes in after 21 days and it doesn't come in high enough, sometimes the seller will think that they just got out scot-free and now the buyer's going to have to buy that house one way or the other, and that's just not the case because this protects the buyer all the way to closing. Paragraph 3 here, time is of the essence. That's not true for the entire Texas Real Estate Commission 1 to 4 family residential resale contract. It is true for this paragraph, okay? For this paragraph, that 21 days is serious business, okay? Paragraph C here, it's just saying that whenever the buyer's buying the house, they're getting financing, that financing instrument that lays out these terms between the buyer and the lender, that's called a note or a promissory note. That never gets filed anywhere. But this is saying that that note must be secured to the property by a vendor's by a deed, basically, is all it's saying. So some kind of deed. It's got to be secured to the property. You've got Section D here, and maybe there's a good reason this is in there. I know the reason why. The reason why is because FHA and VA require this provision to be in the contract, but it basically says what has already been said in the contract. And basically what it's saying is that the property must appraise for whatever amount you put in this blank. And if it doesn't appraise for that amount, then the buyer is not obligated to go through with the sale. And to me, it's kind of the same thing it says above, although the wording is different, so maybe an uneducated brain like mine won't pick up on the nuances here. But still, you just have to fill this out if you're dealing with FHA or VA. And then you've got this last paragraph. It is what it says it is. Authorization to release information. The buyer is giving the buyer's lender permission to release information. Specifically, the thing that I care about is the closing disclosure, okay? Because that's kind of important. It's weird to me that the realtors don't get a closing disclosure just kind of automatically. Like full disclosure makes sense to me, but whatever. I'm not the CFPB. So I don't make the rules. And honestly, because of the CFPB and all the rules and different regulations that lenders are being freaked out by, the lender may totally ignore this paragraph and just say, I'm sorry, I don't care what you have in that contract. We're not releasing any of this buyer's loan information to anybody. And so you can get around that by, you can show them this paragraph, but it's probably an uphill battle. You can get an additional release of loan information form signed by the buyer. That may work. Or you may just have to ask the buyer for it directly. But that's it. That's the form. Your folks, everybody signs here. And if y'all have any other questions, feel free to give me a call, my office a call. Go to my website. We've got some blogs on there about the market and all sorts of interesting stuff. So website is chandlercrouch.com. Feel free to call our office at 817-381-3800. And if you have any questions, comment below. Please subscribe. Share this video to anybody you think would be helpful. And we'll talk to you later. Bye.